Okay, good morning and I guess good afternoon to everyone attending today, wherever you are. My name is Joel Comerford and I will be your host for today's webinar, End of Financial Year Payroll and Superannuation Compliance. Stay ahead of new regulations. So first of all, I'd just like to thank everyone who is in attendance. If you are new, we will have a Q&A section at the end, and don't worry, this entire thing will be recorded. You will have a link. It's on our YouTube channel, and we will provide the slides as well. At the end of this webinar, I will give everyone an email, and that is a great opportunity to ask any residual questions you don't have. If you maybe missed the section in the Q&A, or if you just had anything related to maybe a different topic, but maybe on the same track. Now, as we near the end of financial year, it's never been more important. It's never been more important for businesses, especially startups and SMEs, to understand their tax, payroll, and superannuation obligations. Today's session is designed to help you navigate key compliance updates, understand your tax planning options, and get practical advice to prepare for end of financial year with confidence. Now, I always recommend, but it's difficult. You can only lead a horse to water. Guys, if you have questions, please ask them. You're joined by two extreme professionals today, and you're essentially getting free advice on anything related to accounting, especially in regards to end of financial year payroll and super. So don't be afraid to ask questions. We will do our best to get through to all of them. And as I mentioned, if we go a bit over time and we just can't get through everything, the email is a great opportunity to relay some of those to me, and I will make sure I can get them through to our specialists. What we will cover today: an overview of the latest payroll and superannuation compliance requirements, tax obligations and planning strategies for startups and small businesses, accounting essentials and best practices to stay financially organized, how to avoid common end of financial year compliance mistakes, it's a big one, and finally, how Lawpath can support you with ongoing tax, legal, and accounting needs. And of course, as I mentioned, we will have a wonderful Q&A at the end. Now, our guests. For those who have never met this gentleman, he needs no introduction, but I'm going to give him one anyways. Timothy Quinn, our head of tax and accounting at Lawpath, Tax and Advisory. Tim is a chartered accountant with over 17 years of experience advising businesses on tax planning, business structuring, compliance, and financial strategy. He's worked at a director level in the industry, leading tax divisions and helping companies of all sizes optimize their tax position and stay ahead of regulatory changes. We are thrilled to have Tim here to walk us through the most critical end of financial year insights. Now, for those who have joined us for majority of these, this is rather exciting. We have a new guest today in the accounting field, someone very dear to my own heart. Pradi Hamid, one of our leaders in the accounting team. Pradi is a chartered accountant. He has he's come highly recommended, and he has wonderful, strong background in accounting, bookkeeping, tax planning, financial forecasting and budgeting, financial reporting, and process automation. I kind of feel bad. I didn't really prepare a more in-depth speech for Pradi, but as soon as he gets going, I'm sure you'll understand why he comes so highly regarded. Pradi works closely with businesses to streamline financial processes and ensure full compliance, while empowering owners with the tools to make smart, data-informed decisions. So, yeah, I'm really looking forward to seeing these two juggernauts go at it. Now, that should pretty much be everything from my end. At the end, I will go into details in regards to some of our plans and what we can do and how Lawpath can assist you. If you are really fresh and you've come as a referral, then yeah, fear not. I will go into further detail and how Lawpath can assist you there. But yeah, I'll go ahead and transfer you over to Tim.
Thanks very much, Joel, and welcome to those of you I've met before and a whole lot of you that I haven't. So if this is your first time listening to me present these webinars, forgive me if I do go off topic a little bit. It makes things a little bit more interesting. We've got a few things to cover. Obviously, the title of this webinar is to talk about changes to regulations and end of financial year. Look, for once, there haven't actually been a whole lot of changes to regulations starting from 1 July. It's a rare one for us. Only a couple of small changes. But for some of you out there, some of these changes from the last few years might be new. Or maybe you're new to business and you've never really done payroll before. Plenty of people are in that situation. So we'll try and cover you off from all areas and we'll give you a bit of an insight into some end of financial year tips where you can use your payroll to put yourself in a better tax position. Kick things off, let's talk about what is payroll compliance in Australia. Seems straightforward. It's not. It actually covers quite a few different things. Going all the way up to the Fair Work Act, the actual legal bits and bobs of how you employ people in Australia. We're not lawyers here in the Lawpath tax team, but of course we've got plenty of lawyers on board that are well across all of your Fair Work compliance obligations. That covers wages, overtime, your leave, awards or enterprise agreements, EBAs. Where we, from the tax side, really get involved is on the rest of these compliance obligations. So when we're looking at your PAYG withholding, PAYGW, this is the most common tax that all Australians will encounter at some point in their working life. This is the tax on your salary. So if you go out there and you work for your boss and they pay you a salary, you might be surprised the first time you get your payslip where they've decided to withhold tax on your behalf. How nice of them. It is, of course, a legal requirement for employers to withhold tax. That tax goes straight to the ATO. The ATO doesn't trust you as an employee to do that on your own behalf, so it gets the employer to do it for you. This is a very, very common tax that all small businesses will have to grapple with pretty quickly. You report this PAYGW every time you pay payroll. It has to be same day these days using the single touch payroll using your accounting software. But you also report and then we'll pay that on your BAS or your IAS. We'll talk in a bit more detail later. Superannuation, the big change there is that for those of you with long memories, it used to be 9%. It used to be 3% back in the day when it first came out. I think that was Paul Keating's gig. It's come up and up and up. It's now finally hit the level that everyone's happy at, 12%. So I don't think it'll change for much longer. It'll be 12% from 1 July. And that is 12% on your ordinary time earnings, which can sometimes include bonuses, sometimes it can't. Please do check with your accountant. This payment must be currently paid at least quarterly. You've got one more year at least of that nice irregular payment. But as we talk about a little bit later on, that's going to become more frequent. The last aspect of payroll compliance is about your record keeping and who do you give those records to. Payroll record keeping is actually longer than most tax-related record keeping. You're required to keep most records for 7 years, and that's because of those Fair Work compliance obligations. From a tax perspective, it's only actually 5 years, but we recommend to all of our clients basically keep them for as long as you humanly can. If you've got a digital shoebox out there on your Google Drive or your SharePoint, whatever it is, just keep them forever. You must issue pay slips within 1 working day of payment these days. But of course, if you're using accounting software, very, very straightforward to do that. Look, that's the nuts and bolts of it. Let's get into a little bit more detail without bogging things down too much and getting too boring. Like we mentioned, there are a few key requirements for you to report payroll in Australia. STP, as we've mentioned, is something that you'll electronically report through your Xero or your QuickBooks or your MYOB. That is basically telling the ATO how much you're paying your employees, how much you're withholding in tax. And as we've mentioned before, that is due on or before payday. And then at the end of the year, you've got 14 days basically to confirm all of those details and make any changes if there's been some updates. You've got your business activity statements for all employers. So starting from the second you start to have someone on the books, they'll be once a quarter. They're due at the 28th of the following month with an extra month's bonus extension for December to let you guys all have a Christmas break. Thank you to the ATO. There are extensions to that deadline for registered tax agents, so we get a little bit longer at Lawpath on our client's behalf because the ATO trusts us to do the right thing. unfortunately, they don't trust you. If you are a larger withholder, if you're withholding more than $25,000 a year, which is not a particularly high threshold to meet, you'll actually be asked to withhold monthly with an installment activity statement, which is due on the 21st of the following month. Now, Pradi will know this. Plenty of clients in the past, plenty of small businesses were above this threshold and it was never enforced, and the ATO seemed to never realize. I can tell you that since April, they've been keeping a much closer eye on that. So we're seeing that a lot of smaller businesses have been swept up into this idea of monthly installment activity reporting. So don't be alarmed. It's basically them enforcing the rules that they've had for ages that they never really looked into. Again, I'm just emphasizing again, it's very important to keep records. I would say the most important thing is if everything's going well, you probably never look at these historical records. But I can tell you what, from experience, on behalf of my clients, the second something goes wrong and you get a Fair Work investigation or an ATO audit into your payroll, you'll be very, very glad that you kept such meticulous records when that pops up. So do future you a favor on that one. Just double check to see if we've got any questions coming through. Not yet. Please do lob them at me. Although we're just in the essentials. When we get a bit juicier, maybe you'll liven up a little bit. I've put in a slide here for payroll essentials for startups. So you don't have to be a startup. You could be in an existing business. You could be going for ages. It's maybe a little bit of a reminder. When you do set up a business, these are the key things you do in order to get yourself compliant for payroll. Firstly, you register for PAYG withholding with the ATO. It's not done by default. When you set up and you got your ABN and your TFN registered, you may not have registered for any taxes at all. So that is just an extra thing. You can self-serve to do that online. As with most things with the ATO, it seems simpler than it is, and it can be more complicated. Set up your business bank accounts. Although technically you can run a business without a bank account and you can do it through your individual one. On behalf of the accounting profession, please don't do that. It's an absolute nightmare to sort out and it will increase your compliance costs. So just set up another business bank account. If you go out there, your Westpacs of the world have got very business friendly accounts that will integrate well into everything you do. Thirdly, subscribe to a cloud-based accounting software. Are there any non-cloud-based accounting software still out there? Probably. Please don't get them. They're archaic. Get something online that you can invite your employees to, invite your tax advisors or whoever else you need. They're all fantastic. They're all reasonably similar in terms of their offerings out there. So shop around, see what suits you. Once you've got that accounting software, make sure you connect it up to your business bank account. This will do 80% of the work of a bookkeeper for you. For those of you out there that remember how these things used to work with cash coding and tapping away even into spreadsheets and before that, it was an arduous process. If you connect your bank statement to your accounting software, all of the cash transactions will be in there. And very quickly, your software will learn what most of those transactions mean. It will make your job a lot easier. It will certainly make paying payroll a lot easier. Before you close your browser, please do connect your software up to the ATO. It's using the ATO Access Manager. This will enable you to do things like STP, even your own self-filings for BAS if that's the way you want to go. Every software is a little bit different, but they've all got meticulous instructions, step-by-step instructions for how to do that with the ATO. It's painful the first time you do it, but once it's done for life. So give it a crack. Sixth, I put this in bold. It's a bit self-serving, a bit self-interested. I would just say that those steps seem straightforward. If they fill you with dread, do engage an advisor to help you out. Certainly on the Lawpath Accounting Advice Plan, Pradi and his colleagues will often run you through these steps, and half an hour of your time with Pradi is probably better than 5 hours of pulling your hair out and doing it yourself. Let's talk about what are these new regulations. I've already hinted that there aren't too many of them, so we'll be able to fly through them. Like I said, the superannuation rate, it's been creeping up very slowly. It creeps up another 0.5%. So if you've been used to paying at 11.5%, We're now up to 12. Well, we will be from the 1st of July. So make sure you do calculate at the correct rate. I dare say all of your accounting software will have worked this out already, but just give it a quick double check. And certainly if you're trying to do things manually, make sure that you've factored that in. Monthly withholding, that's an interesting one. This isn't directly related to super or to wages, but it does impact it. For those of you who are consistently late with your BAS, who have been late with making payments, who haven't entered payment plans, or who have exited payment plans incorrectly, you might get a black mark against your name with the ATO. And they might reward you for your non-compliance by tripling your compliance obligations. So they might say, well, actually, we don't trust that you'll do it quarterly because you've demonstrated that you don't. So we'll make you do it monthly. The wisdom in that, I'm still working through. I think the reality is that this will force more small businesses to wind up earlier than they otherwise would as they become overwhelmed by compliance obligations. I would say for those clients who perhaps need a reminder of the importance of getting these things done, this will hopefully get those guys back on track. So if you're a business that puts your tax obligations low on the list of things to handle, perhaps being nudged into monthly withholding. I say nudged, compulsorily nudged by the ATO into monthly withholding. Maybe it will keep you more on track. We are there to support you either way. We will help you with your monthly withholding as well. There's also parental leave on super on parental leave coming in from the 1st of July. Now, this doesn't mean that you as employers will have to pay it, but it's something to be aware of and something to certainly tell your employees about. So for your employees receiving the government's parental leave payments, the government will now be paying superannuation on those payments to the individual's super fund. So just to be aware of. Here's a big one. Here's when we do this webinar in 12 months' time, I dare say we'll have 10,000 people attending. This is because Payday Super is supposedly coming in from the 1st of July 2026. Payday Super means, like it says on the tin, you will have to pay your employees superannuation on the day that you pay their salaries. For those of you who are currently paid in wages weekly, that thought might strike terror into your heart. You might decide to pay fortnightly. You might decide to pay monthly. I think there will be a lot of consultation in the next 12 months. I personally don't think that Payday Super will be ready to go by the 1st of July 2026, but do prepare. Certainly all of the big super funds are preparing. All of the big accounting software are preparing. So watch this space and just keep it in the back of your mind. So we're only 17 minutes into this presentation. We've already covered off all of the new regulations. They're not exciting. There's nothing to them. What are we going to spend the rest of this time talking about? Well, end of financial year is coming up. And if you're thinking payroll around end of financial year time, there are some tax saving opportunities that are payroll related. So I'm going to introduce them just very quickly, and then Pradi's going to take over and get into the guts, get into the exciting bits. What do we mean when we talk about tax planning? Well, how we do it at Lawpath is it's an opportunity for us to talk to our valued customers before year end. There's lots that you can do when you're tax planning, and there are no magic bullets, but there are certainly levers you can pull. You can't really pull those levers after 1 July. You have to do it before the end of the year. Some of those levers do relate to payroll. So when I and my colleagues sit down with our customers to discuss what tax planning is for them this year, what do we actually do? We look at the estimated taxable income for not just your business, but everyone related to your business. So your two working partners, your family members, your other entities, your related entities in the group. We have a look at that. We see where things are going. We try and estimate, look, is there going to be a particular tax bill across the entire entity? Are there strategies and opportunities for us to pull some of those levers, the payroll ones included, and change that overall tax payable to reduce it? Often, I would say almost always, there are steps that we can take now that will reduce your tax payable on the 30th of June. And of course, we do a bit of analysis of some different options, and we meet with you to discuss some of those levers that you might like to pull. Now I'm going to hand over, or just before I do, there's just a quick question. Does superannuation need to be paid to expats if they're on a visa? I would definitely talk to your accountant. There are different superannuation rules for different visa classes and also different classes of tax residency. So I wouldn't want to give an overall answer on that because it is incredibly complicated. Excellent question. And a good time for me to take a back seat and hand you over to Pradi. He's got five payroll-related tax strategies that he is going to talk through, and I am going to hand him over to you now.
Thank you, Tim. Good afternoon, everyone. I will take you through a few of the tax minimization strategy that we normally implement for a lot of our clients, especially those who are still in the initial startup phase right here, right? Now, before we move on to the discussions on the owner salary side of things, I usually take a step back and discuss in terms of what we normally sort of kind of analyze based on the initial investment that a lot of our startup client invested in the business first and foremost. Okay, so for those people who recently registered a company, more than likely you would invested a lot of your personal funds through the company, whether that's paying that through your individual bank accounts, credit cards, or any other form of payments. Okay. The bottom line here is that whatever that you have spent on your personal expenses, we would classify that as part of the director's loan of the company, first and foremost. Okay. So on average, a lot of our clients who recently started their business ventures, they would spend on average around $20,000 to $30,000 as a starting point. Okay, so we would park that $30,000 as part of your director's loan in the company. Okay, now before we explore the owner salaries, which I will discuss shortly, this is where we would start taking into account as to when are you going to start pulling the trigger in processing your salary first and foremost. Okay, so once you've spent the initial investment, more than likely you will spend that on client acquisitions, marketing, advertising, in order you start generating that revenue first and foremost. All right. Once you start generating that revenue, this is where you usually start asking that questions as to how and when are you going to get paid to the company. Okay. One of the main and the simplest way for you to do it is through the owner salaries that I will discuss with you shortly. Okay. Now, I've got some figures that I will discuss shortly here as well. But before we process your first wages or your first salary through the company, right? Our first main piece of advice here is that we would highly recommend you to take advantage of that director's loan balance first and foremost. Okay. What we can do here is that by implementing this director's loan strategy, we can structure the payment of the money that you take out of a company as a reimbursement of your initial investment to reduce your director's loan balance in the company. By structuring it this way, when we start reimbursing your initial investment, you don't need to pay the tax component. You don't need to pay the superannuation component on that. And that will be the most tax effective way for you to start getting paid back from the company. Once you start exhausted all the director's loan balance, this is where we can start talking about processing your director salaries through the company. Okay, so there are two main misconceptions here when it comes to paying yourself for wages through the company, right? There are some client of ours who resisted to pay the salary wages because they thought that, oh, they need to pay tax on that, right? But by just analyzing the numbers that we have provided here, okay, we have a figure of $100,000 profit in the company. by the end of this financial year, for example. If, let's say, you haven't allocated any salary and wages to any directors or any two working directors in this particular examples, you'll be paying 25% cap tax rate when it comes to the tax that you need to pay from the company perspective. In short, you'll be paying $25,000 tax payable at the end of the financial year. Okay.
Hey, Pradi, real quick, Maria Zarifi has just asked, sorry, could you repeat that director's salary part?
Yeah. Does Maria maybe mention the director's loan part, perhaps? Maria, would you be able to confirm, perhaps? Yeah, let's just assume. Yeah, the salary part. Yeah, so yeah, the salary part, this is the one that I'm discussing right here, right? So if, let's say, $100,000 pure profit at the end of the financial, because we haven't actually paid any of the salary and wages throughout the year. So $100,000 profit is the tax that you need to pay from the company perspective, right? But if we exhausted those $100,000 as a salary and wages, okay, the company do not need to pay any tax at the end of the financial year because zero profit on that. All right. And using this example, Maria, we would allocate $50,000 for each and every directors in the company. By doing this, the company actually withholds a portion of the tax as part of your salary and wages that you process at the end of the year. Okay, so given that the $50,000 marginal tax rate is lower than what you be paying on the what you be paying on the company tax rate. Okay, using this example, right, you would only be paying $30,576 in tax total by structuring it this way. Okay, so you can see the significance of tax savings that you can actually implement it by structuring it this way, right? And then if, let's say, the directors have other full-time employments elsewhere, they don't actually need to take on that money, they can reinvest it back to the company, and by putting it back through that after-tax numbers that we have just provided here, right here. Okay. Yes, indeed. Does that answer your questions, Maria? Or any other questions at this stage, perhaps? Thank you, Maria, for your confirmation. Yes, indeed. And then we've got another question as well for Luke here. 45K is the optimal director salary. Above that, then marginal rate become 30%, which higher than the company tax rate. But when it comes to this as well, look, when you're actually comparing the numbers here, right? Bear in mind that the first 18,000 of that 50 will be tax free, right? Therefore, when it comes to the tax perspective, right? We're just talking about the tax perspective here. It'll be a lot more efficient for you to structuring it this way, right? And more importantly, by processing your director's salary and wages, you would also contribute that to your personal superannuation funds as well. All right, and this is one of those things that you might need to consider as well, which Rod has already mentioned as well. Yes, that's true. You will still need to pay super on that, but this is the money that you actually contributed to your own superannuation funds as well on that. That's that. Okay, if there's no more questions on this topic, we can move on from now. Right? Right. So yes, yes. So going back to my earlier point, there is the next tax planning opportunity. What we can do here is that we can start exploring superannuation options when it comes to what we can do throughout the year from the company perspective. All right. So there are two different types of contributions when it comes to the superannuation. Right. So we do have your day-to-day sort of superannuation guarantee obligation. So this is what we call the concessional contribution. For FY25, the concessional super contribution is capped at $30,000, right? And every year it increases slightly as well on this. So I just keep an eye on the FY26. The ATO normally release the contribution cap for each and every financial year. Okay. So what does it mean is that every time you process your payroll, you would need to pay 11.5% up until 30 June 2025. All right. So up until this financial year, you are able to take advantage of this concessional contribution up until the $30,000 cap. All right. I had a lot of clients, especially during this time of the year, who are leaning towards their retirements. This is one of the most powerful tax strategy that we can actually take advantage of right here. Okay, because think of it this way: using the previous example, 11.5% of your 100K would only equal to 11,500. That only contributed to your super balance, right? So that means you would have about 18.5 when it comes to that additional superannuations that you can actually contribute more as part of your yearly contribution cap right here, all right? So how we can do this is we can actually set up the most common way you can do it is we can actually set up as a salary sacrifice to top up a superannuations, right? That way, you'll be able to maximize this cap up until 30,000, because the benefit of this is, yes, we discussed about the 25% cap of the company tax rate, right? When we start contributing your superannuation up until this cap, you could save an additional 10% tax on that, because the superannuation tax rate is capped at 15% on this. So that is an additional 10% tax rate that we can actually implement way before the financial year, right? And yeah, that's that. Secondly, when we run through the numbers when it comes to this, okay, this is one of those numbers that we'll provide here as well. If you, let's say, if you are on a 160 taxable income and decide to contribute $20,000 as voluntary, okay, we've already broken down the number here for you. All right. As you can see on the marginal tax rate that you'll be paying on that 160 will be the second highest marginal tax rate on that this financial year. Okay, so we're talking about 39% marginal tax rate, right? So the more you pay, the more you pay your salary throughout the year, the more savings that you actually be able to implement it before the end of the financial year when you contribute that to your superannuation balance. Okay, and using this example, you could actually save a lot more tax on the on your super as well on this, because 39% on the marginal tax rate is pretty much almost half of your taxable income that you need to pay the tax for. And by contributing that 20,000 to that superannuation tax rate, it'll give you a significant amount of tax rate as well on that. Okay. Yes, Luke also mentioned that, yeah, you could put it through as bonus using bonus tax table instead, and withholding will be lower and correct. Yes, indeed. Right. Yes, so the next point that I would like to discuss here is when it comes to prepayment, right? And this strategies not only apply to your superannuation as well. There are a few other prepayments that you can actually brought forward to this financial year if you have any other sort of kind of expenses that you can brought forward before the 30th of June 2025. Okay, but in short, okay, everything at the very least, going back to Tim's example earlier, at the very least, you need to pay your superannuation once every quarter. Okay, so using the June 25 quarter as an example, the payment of that will be the following month, which is the 20th of July. Okay, so if let's say you have a fortnightly payment, or even you have a monthly, whether weekly, fortnightly, or monthly payment, all right, by paying your superannuations before the 30th of June, you'll be able to use that superannuation as your tax deduction for this financial year. Okay, so normally a lot of our clients sit down with us during that during that last week of the financial year, right? To basically process the payroll. Once we process their payroll, the strategy here is that we'll submit the STP. The single touch payroll. Once we submit the STP, we'll be able to process the superannuation right away on the spot. Okay, so therefore, by taking advantage of this strategy, you'll be able to bring forward your superannuation deductions to this financial year, which will reduce your taxable income even further for FY25. Yes, indeed. Yes, so the next the next sections that I'd like to discuss here is that, yes, when it comes to your tax obligations as well, right? Especially when it comes to payroll. Look, based on our experience, when it comes to the ATO discretions, superannuation is the only thing that they won't negotiate on. Okay, because look, if you lodge your BAS late, if you lodge your IAS late, there's still some sort of kind of leeway for negotiations or even a penalty or interest on that. But when it comes to superannuations, even if you are late by 1 day based on that quarterly payment, you would get hit with the SGC, or what we call the superannuation guarantee charge on that. Okay, so I will discuss that shortly here on the next slide. Now, when it comes to the superannuation, all right, yes, the first thing that you need to be aware of is your due dates. Okay, so rule of thumbs, usually the superannuation will be due on the following month. Okay, and yes, at the very least, going back to my earlier point, you need to pay your superannuations once every quarter. Okay, in order for you to cover yourself on this, there are a lot of our clients that pay their super on a monthly basis, for example. There are some of my clients that pay that on the spot as well, based on their frequency of the payroll. Okay, one of the main things that we normally implement for our clients is that at the very least, when we run through the numbers on a monthly basis, we look at how much GST they collected, how much tax withheld they have generated for that month, and more importantly, how much superannuation is payable for that particular month. All right. So what we normally do is that we start putting aside some cash. We start transferring that. Transferring that amount to a different savings account, in order for you to start preparing yourself when the quarterly payment is due. Okay. The reason why for that is you won't be able to deduct any of your SGC or any of the penalty or interest when it comes to tax time. Okay, there's not only that it will actually reduce your profit, but there's no there's no tax benefit on it, and you won't be able to claim any deductions on those points. Okay. And more importantly, it's crucial for you to have your wages and salary processed through an accounting software, right? Because if there's any miscalculations on the withholding amount, you won't be able to deduct that wages as well as part of your tax time. Okay, so therefore, by implementing this strategy from the start, you'll be able to forecast your cash flow as well and start meeting these obligations in the future, right? And yeah, for those clients who are currently on who are currently owing an outstanding amount to the ATO, it's crucial as well that you set up a payment plan when it comes to that. The reason why is that, look, the ATO will be willing to work with you, especially if you are showing that proactive approach to let them know if you need some help to meeting your obligations. And there's less likely chance for you to get penalized or charge any interest based on those amount owing as well. And yeah, the key here is that we just need to show that proactive approach, and we'll be able to assist you every step of the way as well when it comes down to setting up a payment plan, or even any negotiations that we can do on behalf of your business as well. Okay. Right. Last but not least, there are also other ways for you to reduce your costs when it comes to your payroll or even any of your admin support moving forward. Okay. I have a lot of clients who are employing multiple different staff who are, need a lot of support on the admin side of things. Those clients who are, especially in this kind of situations, they usually tend to outsource their admin or any sort of kind of time-consuming task within the day-to-day operation of the business by outsourcing it overseas. For those clients that opted the strategy, on average, they could save up to 70% of their labor costs compared to hiring the staff onshore. All right, and this relates to the admin and especially the software developments for those clients who are operating in the space. All right, and more importantly, with a tight labor market and rising costs from inflations, these are the options that a lot of our clients are exploring, right? Because not only that you'll be able to reduce your cost significantly, but this gives you the opportunity to focus on what you do best, running your business and maximizing your revenue. So your time will be better to spend elsewhere as well on that, right? Even at Lawpath, there are a few of our functions that we outsource through our partner at Remote Hireling, and yeah, these are the kind of things and the kind of strategy that you just got to keep in mind, given that we've only got about 2 months left of the financial year end. And yes, indeed, that's all for me today. Thank you, Tim and Joel.
Thank you so much, Pradi. Just a few of our many tricks up our sleeve when it comes to obligations, meeting your obligations in a way that is tax effective. So thanks very much, Pradi, and thank you for joining us. Please keep the questions coming through. We've been answering them as they come up. And there was just another Q&A that I've answered privately, I think. But in case you didn't see it, someone was asking about the catch-up concessional contributions. What order are they applied in? If you have an unused cap from 2021 and one from 2024, the rule is that the oldest is applied first. So you would use up your 2021 cap before the more recent years are hit. And we've just had a question here. Don't you need to notify employees that their information will be outsourced offshore? There are certainly privacy obligations in relation to your employees. And Lawpath has on its platform plenty of documents that can help you meet all of your privacy and disclosure obligations. Beyond my pay grade, though, I will say, as a non-lawyer. Just before I do hand you back to Joel to talk a little bit about how Lawpath can help, I just wanted to highlight a few compliance mistakes that we do see. And I've been doing this for 18 years. I've seen them all, probably done a few of them myself. So maybe you can learn from our mistakes and make sure you don't commit them yourself. The really common ones, and I say it's common because there's been enough high court activity that it must happen all the time, the misclassification between employees and contractors. There are entire law firms that do nothing but this, both on the side of the employer and the side of the worker. So this is a very, very common thing. The laws change all the time, so please do keep on top of it. We run regular webinars with Damon, our head of legal, who can help you work this out. Sometimes it is not obvious when someone is an employee and when someone is a contractor, and the contract that they have signed may not be the end of the story. We, of course, look at many different factors to work that out. If you think it feels a bit too good to be true and that you're avoiding obligations for someone that really is treated like an employee, that is a good sign to speak to a lawyer. So get on to one of our lawyers here at Lawpath and we can help you work that out. Late super payments are an absolute pain in the behind. Anyone that has experienced the horror of having to pay super, having to pay penalties on top and interest, and still getting denied a deduction for it, will no doubt have not done it again. Because when you pay super late, the loss of deduction will really hit you. STP errors. Look, STP's only been around for a few years. Not everyone is familiar with it yet. People make mistakes. I will say that the ATO is quite okay with you making mistakes as long as you make good attempts to correct them. But of course, hiring an experienced and trusted advisor here who's been doing this and doing nothing else for a few years is a good way of avoiding those sort of issues. Payslips, I actually see this happen all the time. I see payslips being published late almost by accident, particularly for small businesses that doing payroll is, of course, very important, but very time consuming. And sometimes you push it out to the bank and you think you're done and dusted, and you might think, oh, I'll get around to payslips later. And so sure enough, a few days goes past and one of your employees taps you on the shoulder and says, oh, I didn't actually get a payslip. Just do it while you're paying it. And any of these online cloud-based systems, they are button press, send it out to emails, save yourself the woes of printing things out and giving it in envelopes. Look, poor record keeping is the bane of every accountant and lawyer's existence. It's so much easier to fix problems before they become big. I'll give any of you who haven't experienced the joys of an ATO audit a bit of an insight into how audits work. There are graduations. It doesn't start with someone with ATO written in yellow bold letters on a blue jacket busting down your door and demanding to see your records. That is really the thin end of the wedge. What really happens on a day-to-day basis is that the ATO will call you, or the ATO will call your registered tax agent, like at Lawpath. They will ask questions. If those questions can be easily solved very quickly because you have all those records at hand, that is typically the end of the audit activity. You resolve most ATO queries with a phone call. Sometimes there's a request for written documentation to follow. Most issues that are not solved by a phone call can be solved with an email or with a letter. This is only true if you've kept your records. Anytime you have to throw your hands up and say, well, they were damaged in the great record keeping fire or flood of 2017, it becomes a lot more serious. So do keep those records. I can't emphasize that enough. Underpayments are very, very common, particularly in industries with complicated awards, where there are awards depending on classifications between particular levels, where employees hit age changes and have to go up a level, where they've hit periods of service and have to go up a level. It is really complicated. It's easy to make mistakes. Again, stay on top of it. Do a payroll audit. Pay for someone to come in and have a look at your books. as long as you're changing, as long as you're fixing these mistakes yourself, Fair Work can be reasonable. The ATO can be reasonable. If they're the ones making the updates because you've done the wrong thing and you've been resistant to fixing errors, then that's when it gets a lot more difficult. One last thing before I hand over to Joel. I'll just answer a couple more questions. We've had, is it better to pay bonuses to directors to reduce company tax? You might have missed the one of the earlier demonstrations, so do have a look at the records and the slides that you'll be sent as well. Yes, it can be better to pay bonuses to directors to reduce company tax. There are certainly many scenarios where that's true. And then Wayne's just asked about payday super. Just a reminder, Wayne, this is not law yet. It's not in practice yet. It's not until 1st July 2026. Does a payroll threshold apply? Not to my knowledge yet. I believe it's going to be for everyone, but again, this is early days. And for anyone that's had experience of these payroll changes before, quite often the ATO does push out these timelines. They're not trying to trap people. They're not trying to trap small businesses into being non-compliant. They do typically have transition periods where there perhaps will be thresholds, such as STP. That STP didn't come in out of nowhere in 2022. It came in gradually. So potentially, Wayne, you might be right. They might put some thresholds on that.